Let's quickly revise whatever we have learned in this chapter. Pay attention. So this chapter dealt with computation of cost of capital. The very first thing that we have learned is significance of cost of capital. Any investment decision as such, guys, is evaluated by comparing all the future cash flows with the amount of investment that you're making on the current date. In order to compare those cash flows, guys, you need a discounting rate. Cash flows arising at different points of time cannot be compared. That discounting rate at which you're going to discount all your future cash flows becomes your overall cost of capital. That is a minimum return that you're supposed to generate because it is a cost that the organization is incurring in relation to procurement of funds. After that, guys, I also said that cost of capital is used in determining the credit policy of the company. If the credit period is offered and you would want to know what is the return that is to be collected from the investors or such, guys, or what is the discount that is to be offered for cash discount, you should first know what is your cost of capital. And also to evaluate different sources of capital as such, guys, you will want to select that source of capital which has the least cost of capital. If your overall cost of capital is less, then the present value of cash flows will automatically be higher, resulting in a higher value. That is why, guys, the objective of any organization would be to keep their overall cost of capital as low as possible. That automatically will result in a higher value. The capital structure that results in the least overall cost of capital is called as your optimum capital structure. Alright. After this we have learned about computation of individual sources of capitals, cost of capitals. The first one was cost of debt. I said in relation to debt, interest is not the only expenditure. Usually interest is the only expenditure, but not necessary that you always incur expenditure equal to your interest rate. There can be expenditure that you are incurring at the time of issue of instrument. There can be expenditure that you are incurring as at the time of redemption of expenditure. Even in case of a term loan as such, there can be certain debt agents who are helping you in procuring those loans, who will charge certain amount of fees, and that fees is going to effectively affect your cost of debt. All right. If there are no expenses that you're incurring, guys, at the time of issue, at the time of redemption, you are issuing a security at face value, you're redeeming it at face value, then your cost of debt is effectively equal to your interest rate. And if there are taxes applicable, because you know payment of tax is a charge against profit, it will result in tax savings. Cost of debt will be equal to interest rate into 1 minus tax rate. But if there is expenditure that you are incurring as such at the time of issue or at the time of redemption, guys, then cost of debt will not be equal to your interest rate net of taxes. So that was the very first case that we did in the class. I told you if there's no issue expenditure, redemption expenditure, cost of debt is equal to your interest rate into 1 minus tax rate. After that I moved on to case wherein there is issue expenditure or redemption expenditure. Whenever you see issue or redemption expenditure as such, you will have to check what is the maturity of the instrument. Is it a perpetual instrument or is it a redeemable instrument? If nothing is given, what do we assume? Always perpetual. If there is nothing given, there's always an implied assumption that the instrument is perpetual. Let that be debenture, let that be preference share. So the cost of debt, guys, of a perpetual instrument is based on present value of constant perpetuity. The present value of constant perpetuity is cash flow divided by discounting rate. That is why, guys, you write cost of debt as interest amount divided by net proceeds. Issue price agar question mein de raha hai, please check if there's any flotation cost, because you're supposed to only consider the net amount that you're collecting. If you recall, I gave you an example like how interest is collected in advance. If interest is collected in advance, it affects your cost of debt. I said you took a loan of 100 crores, they deducted 10 crores as interest, and they're giving you only 90 crores. Your cost of debt should be based on 90 crores and not based on 100 crores, because you're effectively able to utilize only 90 crore rupees. So cost of debt for a perpetual instrument, guys, will directly be your interest amount as such, guys, divided by net proceeds. If there are taxes applicable, you will write interest amount into 1 minus tax rate divided by net proceeds. ये कोई shortcut formula नहीं है. This is based on time value of money. This is accurate answer. This is not an approximate answer. If the instrument is redeemable, guys, I said there are two ways of arriving at cost of debt. The first method is IRR or YTM method. IRR is internal rate of return. YTM is yield to maturity. Under this method, guys, the net proceeds that you are collecting today will be equated to the present value of all future outflows. Remember, I'm not computing rate of return, I'm computing cost of capital. That is why it is other way around. Net proceeds today is compared with the present value of all the outflows. The discounting rate at which the present value of all the outflows is equal to the amount of net proceeds, that itself is your cost of debt. While you take your annual outflows, be careful. If there is taxes applicable, you're supposed to take interest amount net of taxes. Do not directly consider interest amount. You made that mistake in one question. Then shortcut method mein beta, using this only beta, I presented a table as to how the amount of debt is fluctuating year after year. I told you while explaining this table that the amount of expenditure is not remaining constant every year. The amount outstanding is not remaining constant every year. That is why using approximate method, we wrote average annual expenditure divided by average annual outstanding amount. For this beta, we wrote interest plus RV minus NP by 2 whole divided by RV plus NP by 2. If there are taxes applicable, you write interest amount into 1 minus tax rate. I also said, guys, that in ICI they presented a point stating that if the difference between redemption value and net proceeds is also allowed for taxation purpose, then even for that you will write into 1 minus tax rate. We did not do that in any of the questions because there are no questions based on that. By default, there is no tax savings on the difference between redemption value and net proceeds. Only if they specify that in the question, guys, you're supposed to take tax savings, otherwise you're supposed to ignore it. Are we clear about this? Then beta, we moved on to the concept of zero coupon bond. A zero coupon bond is a bond that does not result in any payment of coupon year after year as such, guys. It only results in payment of redemption value, guys, that is par value and maturity. You're issuing a bond at discount today, guys. You're going to redeem it at face value after the maturity period. So here there's no shortcut formula. You're directly going to use the accurate method. You equate net proceeds to the present value of redemption value. Whatever is the discounting rate beta itself is your cost of debt. After that beta, we moved on to the concept of convertible debt, guys. I said a convertible debt is similar to a redeemable debt, just that under a convertible debt, guys, the holder of the instrument has an option either to take cash component or to take equity conversion value on maturity. Whichever is higher, guys, obviously is the amount that the investor is going to opt for. So here you have to be careful about computation of equity value. We do not need correct equity price. We need equity price that is going to prevail at the end of maturity period. Just say एक question में बेटा I've used that formula P5 is equal to D6 or P6 is equal to D7 by KE minus D. He gave me what is the dividend beta every year as such, guys. Using that we computed P6. Or in other question beta, he gave us price today and he told us that price is going to increase by 5% year after year or 10% year after year. You directly compound beta and you get price at the end of the maturity period. Baaki pura formula same hai, guys. You can either use YTM method or you can use shortcut method. By default, if nothing is given, we always prefer shortcut method to arrive at cost of debt. Iske baad mein beta I said current cost of debt. Current cost of debt beta is computation of cost of debt based on the prevailing market prices. That is net proceeds will be based on prevailing market prices. If a company were to issue new debt today, guys, or if a company wants to value their existing instruments, they will obviously want to compute, guys, their cost of debt based on the prevailing market prices. That is what we do, guys. After solving all the questions now beta, we have learned one point, that if at all details of market prices are given, we always compute cost of debt, cost of preference share capital beta based on market prices only. We do not have another option. You will have to compulsorily take those market prices for computation of cost of capitals. Iske alawa, guys, under cost of debt, we've also learned about the concept of valuation of a bond. I said the value of a bond, guys, is simply equal to the present value of all future cash flows discounted at the required rate of return. Whatever is the return that you would want to offer to the investors, you discount all the future cash flows at that rate and that will become value of a bond. Amortization of bond will get concept hai, wherein there was a bond of 5,000 rupees better. The principal amount was not being repaid at once. The principal amount was being paid equally. That is amortization. You're not paying the principal amount at once. You're amortizing it over 5 years. So doesn't matter, guys, whether you're paying at once or you're paying it equally. Your job is to first determine what is the annual cash flow. There we wrote 1,000 rupees better plus interest on outstanding amount. Once you get annual cash flows, discount at whatever is the required rate of return, guys, and that will become the value of a bond. This is what we have learned, guys, under cost of debt. After this beta, we moved on to cost of preference share capital. I said cost of preference share capital, guys, is exactly the same as cost of debt. The only difference between cost of preference share capital and cost of debt is that there is no tax savings on payment of preference dividend. So into 1 minus tax rate nahi aane wala hai. Rest everything is same. Nothing is given. We always assume cost of preference share capital is equal to preference dividend rate. If there are some details given, you will have to check whether it is perpetual instrument or redeemable instrument. If nothing is given, again we assume that it is a perpetual instrument. For a perpetual instrument, you write cost of preference share capital beta as preference dividend amount divided by net proceeds. For a redeemable security, guys, you will write preference dividend plus RV minus NP by N whole divided by RV plus NP by 2. This is how you arrive at your cost of preference share capital. After that, beta, we moved on to cost of equity. So under cost of equity, guys, there is no fixed obligation unlike preference share capital or debt. There is still cost of capital beta because whoever is investing in your company is expecting that you will generate some return on behalf of their investments. So there were totally 5 methods that we have learned, guys, under cost of equity. There is capital asset pricing model, dividend discount model without growth, dividend discount model with growth, earnings price approach, and realized yield approach. Under capital asset pricing model, which is the supreme method, guys, the most accepted method all over the globe, the required rate of return, guys, of a security will be risk-free return plus the risk premium that is computed based on risk involved in that security. To be precise, formula is RF plus beta into RM minus RF. RM here stands for the overall market return. RF is risk-free return. RM minus RF is market risk premium. Be careful if they're using the word market return or market risk premium. If they use the word market return, it is RM. If they use the word market risk premium, it is already RM minus RF. Beta compares the risk of your security with the risk of the overall market. If beta is 2.5, it means every time the market fluctuates by 1%, your security is going to fluctuate by 2.5%. Beta is not an absolute measure of risk. Beta only compares your risk with the risk of the market. So in case your beta is 2.5, then the risk premium on your security should be 2.5 times the risk premium of the market. That is why, beta, we write beta times of RM minus RF and then add it to RF to arrive at your overall return. At this point, beta, we've also learned about what is systematic risk and unsystematic risk. I said the valuation of securities, guys, is affected by both factors that are common to all the companies, that is macroeconomic factors, and then factors that are specific to a company. Systematic risk is on account of the first category, macroeconomic factors that are going to affect all the companies that are present in a country or globe as such, guys. Unsystematic risk is on account of company specific factors. Now, CAPM assumes that there should only be risk premium for companies, for only systematic risk, guys, and not unsystematic risk. Because unsystematic risk can be diversified, can be reduced by you investing money beta in multiple securities. Higher the number of securities that you invest in, higher will be the, lesser will be beta the unsystematic risk. Are we clear about this? After this, beta, we moved on to dividend discount model, guys, with and without growth. As per dividend discount model, the price of an equity share is simply equal to the present value of all future dividends. P0 is equal to present value of D1, D2, D3, D4, so on till infinity. P0 is ex dividend and not cum dividend. It includes dividends from the next year. If dividends are constant, guys, year after year, you directly write P0 as dividend divided by cost of equity, which means cost of equity can be written as dividend divided by P0. But if dividends are growing at a constant rate, guys, you write P0 is equal to D1 by KE minus G, using which you beta wrote KE is equal to D1 divided by P0 plus your growth rate. Alright, guys, yaad rakhna, here when you're computing cost of equity, price should be net of flotation cost, net of discount. Are we clear, guys? And dividends are from dividends from first year. These valuations are always based on ex dividend basis and not cum dividend basis. The growth rate here, beta, can either be computed on the basis of past earnings or it can be computed on the basis of Gordon's model. On the basis of past earnings, they will give us details of the last couple of years, beta. You're supposed to take the time difference and accordingly arrive at your growth rate. We did this in multiple questions, guys. Almost all the questions, growth rate, if it was not given, it was based on past earnings only. Based on Gordon's model, beta, growth rate is dependent on the amount of reinvestments that you make and the return that you generate on those reinvestments. That is why we write growth rate is equal to B into R. B is retention ratio, R is return on. Retention ratio, guys, is 1 minus payout ratio. If I'm paying out 40%, that means I'm retaining 60%. Whatever return that I'm generating on that 60% will become my growth rate. Are we clear about this? After this, beta, we moved on to earnings price approach. I said unless otherwise given, you're not supposed to use earnings price approach. You're not supposed to use realized yield approach. The only methods that you're going to use, beta, is dividend discount model or capital asset pricing model. Isme bhi, beta, if they give us details of capital asset pricing model, that is the first preference. If we do not have details of capital asset pricing model, then we move on to dividend discount model. As per this, there was only one question in which we have used earnings price approach because they did not give us any other factors. They gave us P ratio. So 1 divided by P ratio beta was our cost of equity there. Cost of equity as per this method is earnings divided by market price of the share. We do not normally use this because you do not realize all the earnings made by a company. You will not be able to reinvest those earnings if you want, guys. That is only the profits made by the company. That is not the cash flow distributed to investor. All right. Realized yield approach, guys, is nothing but that the cost of equity will be dependent on the actual return that an investor has generated in the past. I said again irrelevant, guys, because this method assumes that if you have incurred losses in the past, cost of equity is negative. If you have incurred an abnormal return as such beta, then cost of equity is that equal to that abnormal return, which is incorrect. Under this also beta, there were two ways of computing actual yield. In one question beta, they did not give us price prevailing every year. They only gave us dividends and they gave us price at the end. I said the present value of all the dividends and price at the end was equated to your initial investment. Whatever was the discounting rate itself is your cost of equity. If they give us price at the end of every year beta, we assume that reinvestments are made in the same share. So when reinvestments are made in the same share, you start with certain amount of investment, keep calculating how much dividend are you receiving, keep calculating how much money are you receiving on reinvestments as such, guys. This was the question beta, to be more precise. We took certain amount of investment as such, guys. We reinvested that amount in the same share as such beta. We kept increasing the number of shares. At the end, whatever number of shares that we had beta, we equated that with the initial amount of investment and computed actual return. This is computing realized yield with reinvestments, but reinvestments being made in the same share. Are we clear, guys? Yes or no? This was all about cost of equity, guys. After that beta, we moved on to the concept of cost of retained earnings. I said cost of retained earnings, guys, is exactly the same as cost of equity. There's only one difference, guys. Retained earnings will not result in any extra expenditure, guys, on behalf of the company. If I'm declaring dividend first and then I ask investors to bring in money by issue of equity shares, guys, I will incur cost on issue of equity shares. So इसीलिए for computation of cost of equity, I'm supposed to consider discount on issue of shares. I'm supposed to consider flotation cost. But for computation of cost of retained earnings, we are supposed to take the existing market price. Unless because of a higher risk, existing market price itself is coming down. If the existing market price itself is coming down, then even cost of retained earnings will be based on that reduced price. We did not have to worry about that point. That point was not given anywhere. जहाँ पे भी बेटा because of higher risk price of equity came down, they gave us only equity. They did not even talk about retained earnings. Are we clear about this? बाकी सब same है बेटा. There's no difference between cost of equity and cost of retained earnings. Now, overall cost of capital, guys, is an average cost of all the sources of capital. So you multiply weights of individual sources of capitals multiplied by their cost of capitals. Now, the market value of equity, guys, is the value of all the categories of equity shareholders funds. Let's say I gave the example of HDFC. I said the market value of HDFC is 13,16,205 crores. Whereas the book value of capital beta is 4 crores, 4,53,741. Market value of equity is the combined value of all the shareholders funds. In case cost of equity is not equal to cost of retained earnings, then I will have to segregate this market value of equity into two components. How much is equity share capital and how much is retained earnings? In what ratio are we supposed to segregate? In the ratio of their book values. That will tell us how much values are to be taken. In case cost of equity is equal to cost of retained earnings, you do not have to segregate. Because even if you segregate, you're going to get the same answer. Even if you do not segregate, you're going to get the same answer. Are we clear about this, guys? Any doubt in this? Now, इसके अलावा बेटा, हाँ, whenever they give us market prices, I already told you बेटा that cost of capital should be based on the prevailing market prices and not based on the original price बेटा. मतलब original issue price अगर दे रहा है तो undoubtedly you will give that preference. If they do not give us original issue price, they simply give us market price details. You will have to take market price details. Are we clear? Yes or no, guys? इसके अलावा बेटा there were a couple of questions, guys. एक second. जैसे question number 20 कहाँ गया था ये? हाँ. Question 33, 34 I said which are important as such beta, wherein company wants to raise additional funds. All of you made a mistake. You thought that these additional funds are apart from what you already have in the form of retained earnings. I said incorrect. When the question says that you need an additional funds of 10 lakh rupees, this is all sources of capital put together, including the amount of retained earnings. This amount you're directly supposed to segregate, guys, in the ratio of debt equity given in the question. Equity will include both retained earnings as well as equity share capital. You accordingly compute that. All right. If at all they give us EPS beta in a question and give payout ratio, by default that EPS is not expected EPS, it is reported EPS. meaning that EPS multiplied by P ratio will not give us D1, it will give us D naught. You're supposed to adjust growth rate to arrive at D1. Are we clear बेटा? उसके अलावा तो बेटा हाँ, this 33rd question में बेटा 35th question they asked us to also compute what is the amount of reinvestments that you can make guys out of retained earnings. I said do not directly equate retained earnings to investment. There's a capital structure ratio. यहाँ पे बेटा to be more precise 80% of the overall capital was in the form of equity and we had retained earnings of 2,77,300. I said 80% of your overall investment should be equal to that 277,300. That is the amount of investment that you can make out of retained earnings. If you make anything more than that as such better, you will have to depend on issue of equity shares. Marginal cost of capital is weighted average cost of capital better of all the additional funds that are being raised. Are we clear guys? That's it better. Sales price, हाँ बोला बेटा. If sale price is already given in the question guys, then you will have to take that sale price. जैसे question number 27 में बेटा, though they gave us market prices, they also specified sale price. That is why for computation of cost of capitals, I took sale price. I did not take market prices. And by default, flotation cost बेटा will be as a percentage of issue price, not as a percentage of face value, unless they give that it is a percentage of face value. All right, very good बेटा. All right guys, let's revise leverages first and then we'll move to capital structure theories. I said better leverage ka mathematical leverage ka definition guys is the mathematical relationship between two variables. Even in this chapter better we're trying to establish relation between sales, operating profit and the earnings that are attributable to your equity shareholders. For this we have learned about cost structure and capital structure of a firm. Cost structure is the proportion of variable cost and fixed cost in the overall cost of the firm. Capital structure guys is the proportion of debt, equity and preference in the overall capital of the firm. A company which has automated operations will have a higher amount of fixed cost, lower amount of variable cost. Company with manual operations will have a lower fixed cost but a higher amount of variable cost. Likewise, a company with a higher amount of debt and preference will have a higher fixed financial cost. A company with a lower amount of debt and preference share capital will have a lower amount of fixed financial cost. Whenever your sales are changing by a certain percentage, your total cost will not change by the same percentage because of the presence of fixed operating cost. Higher the proportion of fixed operating cost, lesser will be the change in total cost. Lesser the proportion of fixed operating cost, higher will be the change in your total cost. We took examples of 3 entities better. I gave you changes in total cost as such guys of all those entities. When sales changed by 20% better, we proved that the profitability was not changing by 20% only because of the presence of fixed cost. A firm which has zero fixed cost as such better, we saw that the percentage change in sales and the percentage change in profit was same. That is company 3 here. A firm that has a little lower fixed cost as such better, the first company as such guys, the percentage change in profit was 30%, percentage change better in sales is 20%. Then better a firm that has a higher amount of fixed cost, that is company 2 here better, we have a higher amount of percentage change in profit for 20% change in sales. So what we understand here better is higher the amount of fixed cost, higher will be the percentage change in your profits. Lesser the amount of fixed cost, lesser will be the percentage change in profits. Alright guys, वैसे ही बेटा if you have a higher amount of fixed financial cost, every time operating profit changes, your earnings attributable to equity shareholders is going to change by a higher proportion if your fixed financial cost is high, because that is going to remain constant and जो भी तुम लोग incremental earnings कमा रहे हो बेटा, that will all go to equity shareholders. Now for this purpose better, we have divided the overall risk of an organization into 2 categories called as business risk and financial risk. Business risk is on account of operations of the firm. Okay. If a particular company as such better is capital intensive, that means better the amount of fixed cost is going to be very high. It will have a higher amount of business risk. If a particular industry as such better is labor intensive, then it will have a lower amount of fixed cost, that in turn beta will result in a lower amount of risk. That is because of fixed cost. Okay? There can be other factors beta that are still contributing to business risk, but on account of fixed cost the risk is going to be less. Financial risk guys is on account of capital structure. Higher the amount of debt, higher the amount of preference share capital, higher will be your financial risk, because you have a fixed obligation guys to pay interest, you have a fixed obligation to pay preference dividend. If these capitals are less, the amount of financial risk is going to be less. Operating leverage guys measures your business risk, financial leverage beta measures financial risk. Operating leverage beta is establishing a relation, guys, between your operating profit and sales on account of the presence of fixed operating cost. So that is why the formula for operating leverage beta is percentage change in operating profit divided by percentage change in sales. You can write percentage change in sales or contribution, one and the same. If your operating leverage beta is 2, it means every time your sales change by 1%, your operating profit is going to change by 2%. The other formula for operating leverage beta is writing profit before fixed operating cost divided by profit after fixed operating cost. That is contribution divided by EBIT. Financial leverage, guys, is establishing a relation as such, guys, between earnings attributable to equity shareholders and operating profit. Every time your operating profit changes by 1%, what is going to be the impact on earnings attributable to equity shareholders is what is given by financial leverage. That's why the formula is percentage change in EPS or earnings attributable to equity shareholders divided by percentage change in EBIT. If there is no preference share capital, you can also write percentage change in EBT, percentage change in EAT. All of them are going to be same if there is no preference share capital. Alright, guys. The other formula beta here is profit before fixed financial cost divided by profit after fixed financial cost. Your profit before fixed financial cost beta is going to be EBIT. Profit after fixed financial cost is going to be EBT. This is again assuming that there is no preference share capital. If your financial leverage is 2 beta, again, what does that mean? For every 1% change in your operating profit, the earnings attributable to equity shareholders are going to change by 2%. Combined impact of both operating and financial leverage beta is given as combined leverage. The combined leverage is the product of operating leverage and financial leverage. You can also write that as percentage change in EPS divided by percentage change in sales. Or the other formula beta is contribution divided by EBT. Again, assuming there's no preference share capital. If at all there is preference share capital beta, because preference dividend is also a fixed financial cost, guys, you're going to make an adjustment beta to the amount of earnings. The formula beta is still profit before fixed financial cost divided by profit after fixed financial cost. But tax is not a fixed financial expenditure. That is why tax cannot be considered, guys, in that formula. Preference dividend is payable out of post-tax profits. Interest is payable out of pre-tax profits. We are making adjustment to pre-tax profit. That is why what we did beta is we converted preference dividend, guys, into pre-tax amount. In order to pay preference dividend, what is the amount of pre-tax profit that you need as such beta is what we're trying to do here. That is given by preference dividend divided by 1 minus tax rate. Operating leverage is not going to change, guys. Financial leverage beta will be EBIT divided by EBIT minus interest minus preference dividend by 1 minus tax rate. Percentage changes mein beta you're going to write percentage change in EPS or percentage change in earnings attributable to equity shareholders divided by percentage change in EBIT. You can no longer write percentage change in EBT or EAT. Yaad hai beta? Yes or no, guys? Obviously combined leverage also beta is going to change because of this formula. इसके बाद में बेटा in a couple of questions we have spoken about asset turnover ratio, we have spoken about favorable financial leverage. This is computation of leverages. सबके सब questions बेटा were only about computation of leverages, nothing else in this entire chapter. Now there are two important theory parts that I told you beta. Financial leverage as trading on equity, financial leverage as double S Ford. I'll come to favorable part here. Now financial leverage beta as trading on equity means with a given amount of equity as such beta you're trying to expand your total capital base by incorporating debt and preference share capital. As long as the returns that you are generating exceeds the cost of debt or the cost of preference share capital as such beta, you will be doing a favor to the equity shareholders by maximizing their returns. This is called as trading on equity. So if at all there is a question on favorable financial leverage, you're supposed to compare ROI with cost of debt. But ensure that both of them are pre-tax or both of them are post-tax. You cannot compare one pre-tax and the other as post-tax. Return on investment will be EBIT divided by total amount of investment. So if ROI is greater than cost of debt, you simply write that the firm has favorable financial leverage. The other aspect that we did beta was financial leverage as double S Ford. Double S Ford में मैं बोला बेटा that you're supposed to talk about both advantage as well as risk. ठीक है? The advantage as such guys of financial leverage is that as long as your ROI is greater than debt as such beta cost of debt, Your incorporating debt as beta will result in a higher amount of EPS, will result in higher amount of earnings beta to shareholders. However, guys, if at all the sales start decreasing as such, guys, which happens in case of financial distress, then what will happen beta? Your ROI will be less than cost of debt. If ROI is less than cost of debt beta, the earnings attributable to equity shareholders will get significantly impacted. Are we clear, guys? That is financial leverage as double S Ford. Are we clear? इसके अलावा बेटा asset turnover ratio was the other formula that we have seen. Asset turnover ratio is how well are you utilizing your assets in generating sales. That is why it is sales divided by assets. If asset turnover ratio is 2 times better, it means that for every 1 rupee of asset, we are generating revenue of 2 rupees. You compare that with the industry average to know, guys, whether you are generating a lesser return or a higher return. The next beta is you relating operating leverage with break-even point with margin of safety, guys. I said break-even point under costing as such beta refers to operating profit. Yes or no? Your operating profit as such beta should be 0 at your break-even point. So if a firm has a higher operating leverage as such, guys, it means the amount of operating fixed cost is very high. It would also mean beta that your break-even point will be high, resulting in a lower margin of safety. As your sales keep increasing as such, guys, the proportion of fixed costs will keep reducing. This will reduce your break-even point and it will increase your margin of safety. All right, beta. Now, we've also established the formula that degree of operating leverage is equal to 1 divided by MOS. So if they give us MOS, ask us to compute break-even point, which they can do beta in MCQs. If margin of safety is given as 10, that means your operating leverage beta is 1 divided by 0.1 10 times. And margin of safety 10% है मतलब break even point is 90%. That's the relation between margin of safety, guys, and operating leverage. I also told you better that all the leverage values should be greater than 1. It can never lie between 0 and 1. If at all leverages are negative, guys, it means that your profits are negative. ठीक है? Either numerator, मतलब numerator नहीं, denominator as साथ beta is negative. Say contribution is 5 lakhs but fixed cost is 8 lakhs. Now EBIT will turn negative. If EBIT is negative, that means operating leverage is negative. It also means if your operating leverage is negative, you're operating at lesser than break-even point. You're not even recovering your fixed cost. So there's no question of margin of safety only here. Are we clear, beta? Then we also read about the comment part as such, guys. I said if both of them are low, that means you're not taking any risk at all as such, beta. But if both of them are high, operating leverage is high, financial leverage is high, it's a riskier combination as such, guys. The best combination out there, beta, will be lower operating leverage and a lower operating leverage will ensure that you have sufficient amount of EBIT as such, guys, to cover your interest amount and so that you will be able to take advantage on account of debt. Are we clear, guys? Also the other wordings that they've used in question, guys, that a 25% reduction in sales will wipe out your EPS. Matlab kya beta? There will be a 100% reduction in EPS, guys, for a 25% reduction in sales. That means combined leverage is 4 times. If at all they ask us to comment from the perspective of risk and return, guys, you have to check whether cost of capitals are given in the question. If they are not given, the only way you compare risk and return at this level beta is by computing leverages. Higher the leverage, higher will be the risk factor. Lesser the leverage, lesser will be the risk factor. Also, guys, in one of the questions, we have related operating leverages with beta factors. I said beta establishes a relation between risk of the security with risk of the overall market. Operating leverage is measuring risk. So higher the amount of operating leverage, higher the amount of risk, higher should be your beta factor. Are we clear, guys? All right, beta, that's it. Dear drive students, we're now revising capital structure theories. So guys, under financing decisions, beta, we had capital structure theories. The word capital structure means what is the proportion of debt, equity and preference in the overall capital of the firm. Now, capital structure decision is important because the objective of any firm beta would be to reduce the overall cost of capital. Lesser the overall cost of capital, lesser will be the discounting rate as such, guys. Higher will be the value of the entity. So optimum capital structure is that capital structure beta where the overall cost of capital is the least. Are we clear, guys? So the primary considerations, guys, in deciding as to whether we should raise money in the form of equity, debt or preference, guys, I told you depends on risk, cost of control, guys, and dilution of cost of capital and dilution of control. Risk to the company basically beta is higher when you raise money in the form of debt, because no matter what is the profitability of the organization, guys, we are still supposed to pay interest, repay principal as and when it falls due. As far as cost of capital to the company is concerned, better the cost of capital would be the least when the company is raising money in the form of debt. Also, debt has a tax advantage as such, guys. Investors of debt better take a lesser risk. That is why their expectation is less. That is why the cost of capital is also less. If you're raising money by issuing equity shares to outsiders, guys, then your existing control beta is going to get diluted. So these are the three basic points as such beta that we have to keep in mind while deciding about the capital structure. Now, irrespective of the capital structure theory that we are following here, guys, I told you that there are certain assumptions. First important point is that we have only two sources of capital. One is equity, the other one is debt. There are no taxes applicable. Even if taxes are applicable, you should be indifferent is what you have learned. Now, हर एक theory में बेटा we have determined value of the firm, you have determined value of equity. Value of a firm as such, guys, here will be equal to EBIT divided by KO. If there are no taxes, EBIT itself is the amount of earnings that is attributable to all the providers of capital. That is why you'll write V is equal to EBIT by KO. Value of equity under all the firms as such, guys, is equal to net income divided by cost of equity. The relation between them beta is that V is equal to E plus D. कोई भी theory उठा लो, we are going to use the same formulas. All right. Now, under the theories, guys, the very first theory that we discussed was net income approach. NI, net income, stands for earnings that are available to equity shareholders. So that is why we assume under NI beta that irrespective of the level of debt, KE remains constant. Under NI beta, what remains constant is KE, irrespective of the level of debt. That is why, guys, as you keep increasing the level of debt in the company as such, guys, your cost of debt is also constant. But because cost of debt is less than cost of equity, your overall cost of capital will keep reducing as you keep increasing the proportion of debt. That is under net income approach, guys. Under net operating income approach, net operating income का मतलब होता है बेटा EBIT. That is the earnings that are available to all the providers of capital. Under NOI approach as such, guys, we assume that no matter what is your capital structure, your KO will remain constant. As you keep increasing the amount of debt, guys, what happens is the risk to equity shareholder increases. That in turn beta will result in an increase in cost of equity. So though your cost of equity is increasing, that will get offset by a lower cost of debt. That in turn beta will ensure that your overall cost of capital remains intact. Are we clear about this? How are they going to ask questions under NI and NOI approach, guys? Under NI approach, the requirement will be to compute KO. Under NOI approach, the requirement will be to compute KE. कुछ भी रहने दो, you are going to use these formulas only. You are going to write V is equal to EBIT by KO, E is equal to net income by cost of equity. A better version than NI and NOI approach better was traditional approach. Traditional approach better. क्या हुआ कुछ? Traditional approach better recognizes the fact as such, guys, that nothing remains constant. Your cost of equity will not remain constant, cost of debt will not remain constant. Initially, as you increase the amount of debt as such beta, there will be a marginal increase in cost of equity, there will be a marginal increase in cost of debt. But that in turn beta will have a positive impact only on the overall cost of capital. Your KO beta is still going to reduce. Beyond an acceptable level of risk, guys, your cost of equity starts increasing at an increasing rate, your cost of debt starts increasing at a higher rate. That in turn will have an impact of increasing your KO. Believe me, guys, I'm doing this revision only for you guys. मेरे को कुछ नहीं मिलने वाला है. So, KO in turn as such beta will start shooting up. That is why as per traditional approach as such beta, there's going to be only one optimum capital structure, and that is for you to figure out what is that proportion of debt and equity where the overall cost of capital is the least. NI approach में बेटा ऑप्टिमम कैपिटल स्ट्रक्चर का डेफिनेशन क्या रहेगा? कीप इंक्रीजिंग द अमाउंट ऑफ डेट. NOI में एनी कैपिटल स्ट्रक्चर इज ऑप्टिमम कैपिटल स्ट्रक्चर. दीज थ्री theories. इसके बाद में बेटा we moved on to MM approach. MM approach में बेटा we did two things. One is without taxes, one is with the taxes. Without taxes में बेटा MM approach में exactly same as NOI approach. It does not matter as such, guys, as to what is the level of debt or equity. Your overall cost of capital is going to remain constant. With the taxes, guys, MM approach acknowledges the fact as such beta that a levered firm, unlevered firm का मतलब होता है the firm that has 100% equity, levered firm has some amount of debt. So MM approach acknowledges the fact as such beta that a levered firm will have certain tax advantage on account of debt. That is why, guys, the value of a levered firm is always going to be greater than the value of an unlevered firm. To arrive at value of an unlevered firm, you can write EBIT into 1 minus tax rate by KO. Or this can also be written as net income by KE, because anyways there is no debt. But exam में you're not going to write NI by KE because it is value of the entire firm. You're still going to write it as EBIT into 1 minus tax rate by KO. ये अलग बात है, दोनों same है because it is 100% equity. Value of a levered firm, guys, this is firm, this is not value of equity. Value of a levered firm beta will be value of unlevered firm plus tax advantage on account of debt. Tax advantage on account of debt beta has been computed assuming that debt is perpetual and by discounting tax savings on interest at pre-tax cost of debt. So that derivation beta resulted in tax savings as debt amount into tax rate. Once you get value of a levered firm, you're supposed to reduce the amount of debt from value of levered firm. The balancing figure will be value of equity. Once you get value of equity beta, you can compute cost of equity by writing net income divided by value of equity. पहले value of levered firm लाओ, deduct debt, arrive at value of equity. Compute net income. यहाँ पे net income computation में remember you have to deduct interest, you have to deduct taxes, and then arrive at net income. So net income divided by value of equity will be cost of equity. इसके बाद में बेटा you will be expected to compute KO under MM approach. I told you only this is the only where beta place wherein KO will be computed as weighted average cost of capital. You will take value of debt, you will take value of equity, you will multiply by respective cost of debts. भूलना मत ये चैप्टर में बेटा, because taxes are applicable, cost of debt will not be equal to interest rate, it will be equal to interest rate into 1 minus tax rate. To not make that mistake, क्योंकि बाकी हर जगह taxes नहीं थे, यहाँ पे there is tax, you are going to write KD as interest rate into 1 minus tax rate. Are we clear about this, guys? So these were the 4 theories, guys. इसके बाद में बेटा there was also trade-off theory, guys, and then pecking order theory. Trade-off theory as such beta says that debt has both its advantages and disadvantages. The advantage of debt, guys, purely is tax advantage, tax savings that you get, guys. But beyond the point as such beta, as you keep increasing the amount of debt, because the financial distress increases as such, guys, the value of a firm will not keep up with the tax savings on account of debt. जितना ज़्यादा debt है बेटा, the gap is going to widen. I told you as the debt level increases, the cost of you procuring every resource is going to increase. चाहे वो cost of debt रहने दो बेटा, चाहे वो cost of equity नहीं बेटा, cost of resources like suppliers, guys, employees or anything, all of that beta is going to increase because the company has a high amount of debt. So it is for you to figure out as such, guys, as to what is the perfect balance between the advantage of debt and the disadvantage of debt. As long as the incremental benefit is greater than the incremental cost as such beta, you are good to go. You should continue as such, guys, increasing the amount of debt. Pecking order theory बोलता है बेटा that every person has their own preference. Normally the preference is first retained earnings, second external funds. External funds अभी बेटा you would raise it in the form of debt, उसके बाद में guys in the form of equity. I told you lately, guys, very large entities as such, guys, are resorting to zero debt policy. That means they prefer raising money in the form of equity and reducing the amount of debt rather than having funds in the form of debt. Are we clear, guys? इसके बाद में बेटा I said हाँ trading on equity बेटा ये सब उसमें पढ़ा चुका हूँ मैं already. Remember? Under leverages, but I told you trading on equity, it's all about favorable financial leverage. ROI is greater than cost of debt. You can incorporate debt and increase the return on equity. In fact, there was one question, guys, in the ratio analysis also wherein we did impact of debt on return on equity. ROI minus KD into D by E. 12%, 15.6%. Increase in return on equity on account of debt was 3.6%. इसके अलावा बेटा this chapter also talks about 3 factors: EBIT, EPS, MPS analysis, indifference point, financial break-even point. EBIT, EPS, MPS analysis beta is that we know what is the expected EBIT from a project. We are going to compute EPS under different capital structures. Whichever capital structure results in the highest EPS, that alternative is to be selected. EBIT, MPS analysis में बेटा instead of taking a decision on the basis of EPS, we take a decision on the basis of standard question बेटा यहाँ पे is that in case you borrow funds, additional funds in the form of debt and your debt equity ratio increases, then P ratio will come down. So you will have to compute market price per share under both the alternatives. Dead important beta. अगर ये chapter से 7-8 marks का question आ रहा है, it has to be only that question. That in you're raising additional funds, and if nothing is given, those additional funds will have the same ROI as the existing project. कुछ याद आ रहा है? They will give us retained earnings also. We compute total capital employed. We write EBIT by capital employed to compute ROI and meditate for some time. Yes or no, guys? So, unless otherwise given, first preference is always given to MPS. If we do not have details of MPS, then we take a decision on the basis of EPS. Wealth maximization is always superior to profit maximization. The second factor beta here is EBIT, EPS indifference point. Here we do not know EBIT. What we're trying to compute beta is the level of EBIT at which EPS will remain constant under two or more alternatives. For this to happen as such beta, you equate EPS by keeping EBIT as an unknown factor. If your expected EBIT beta is greater than the indifference point, you select the alternative, guys, with a higher fixed financial cost. If your expected EBIT is less than the indifference point, you select the alternative beta with a lower fixed financial cost. Are we clear, guys? At this point, I also told you guys that there are other cases possible. Total 3 One is normal beta, you get your indifference point. The second one beta is where indifference point cannot be computed at all. ये indifference point cannot be computed at all कब आएगा बेटा? Wherein LHS is not equal to RHS. If LHS is not equal to RHS as such, guys, that means there is no indifference point at all, and one alternative will always be superior to the other alternative. यहाँ पे बेटा usually in such cases the amount of equity is constant, and in one you have debt, in the other you have preference share capital. You can compare their cost as such beta, you will know which alternative will always be preferable. The other scenario beta is where any EPS, EBIT beta is an indifference point. That will happen beta where LHS is equal to RHS. Some strike हो रहा है but 0 is equal to 0 आ रहा है. That means, guys, irrespective of the amount of EBIT as such beta, your EPS is going to remain same under all the alternatives. So that is where as such beta your any EBIT level will be an indifference point. ये सब comments में पूछेगा. You should know how to compute this. So 3 cases. One is normally you have an indifference point, only one indifference point. Second, any EBIT is an indifference point. Third, no indifference point only possible. The last one beta is financial break-even point. I said financial break-even point as such, guys, is the level of EBIT at which EPS is 0. You have to reverse calculate. You should take earnings attributable to equity shareholders as 0, add back preference dividend, add back taxes, add back interest, and arrive at the amount of EBIT. Are we clear, guys? इसके अलावा बेटा the last one which I told you was important, guys, is overcapitalization. And overcapitalization, guys, is basically a scenario wherein you have a higher amount of capital as such, guys, than what is actually required, or the firm has been continuously incurring losses as such, guys, and the true value of the assets is way less than what is appearing in the balance sheet. So in case you actually have excess funds, you repay it back to your shareholders as such, guys. Or in case the true value of the assets has declined drastically, you undertake internal reconstruction as such, guys. Write off capitals, write off assets. Undercapitalization beta is basically a scenario where the firm has lesser amount of capital than what is actually required, which can be profitably employed. So undercapitalization is far better than overcapitalization. Having less capital would only mean beta that you have a chance to expand, but you're not putting shareholders' wealth at risk. Are we clear about this? All right, beta. That's the end of this also. Yeah, there was arbitrage opportunity, guys, that we did, guys, under approach beta. Now, the two kinds of arbitrage that we did, guys. One was moving in from unlevered firm to levered firm. The other one beta was moving from now. What we have to do better here is value unlevered firm, value levered firm. Whichever firm has a higher value, guys, that is overvalued. Whichever firm has a lesser value, that is undervalued. You always shift from overvalued firm to a undervalued firm. If unlevered firm has more value as such, guys, obviously you assume that you have some stake in unlevered firm and you're selling that stake and you're investing in levered firm. So you sell equity here, but when you invest in levered firm, you invest in both equity as well as debt, because levered firm has both. Likewise, if levered firm is overvalued, what you do beta is you sell equity, you borrow debt, and then invest beta in equity, because the amount of money that you're going to need as such, guys, to invest in an unlevered firm will be higher. वहाँ पे सिर्फ equity है, you will need a higher amount of money. Under this also, beta, I told you that there are multiple ways of presenting the answer. What they're looking at is, beta, in terms of earnings. I told you in terms of wealth compute कर सकते हो या फिर in terms of earnings. In terms of wealth में बेटा you keep the percentage holdings constant, you will be immediately left with the surplus. In terms of earnings as such guys, you invest everything that you have received as such guys, but this will in turn result in an increase in your annual earnings. You recall that beta? Exam mein I said beta they're concentrating more on increase in annual earnings. The other day also someone asked it out. How did you decide 1:1? I said it depends on the capital structure of the firm. अगर कंपनी के पास 1:1 capital structure है बेटा, you are also going to invest that entire capital in the ratio of 1:1. That is how it is going to increase the amount of your earnings. Are we clear, kids? Anything else?